this class is going to end 2:30 punctually because there's another review session that's scheduled right after that, so we can't run over that. So anything that we don't cover, you always have the Blackboard discussion board, okay, which is open and people have already asked questions. And so you can ask your questions there, and of course till next Sunday. Next Sunday everything closes down and we have the final. And then 3 o'clock next Sunday your life starts again, so you can look forward to that. So we're going to go in a random order, and all you have to do is call out a number, and if you have something specific to ask about it, that's really wonderful, and we'll try and get that question on. We'll start now, so you have the questions. I don't have the questions. Oh, you don't have the questions? Okay. Fine, so just start. Yes? 213. It's already up there? Okay, we're getting there. 213. 213. ABC issues 1,000 shares of 6% at the beginning of 2010. All the remaining shares are common stock. The company was not able to pay a dividend in 2017, but plans on paying a dividend of $18,000 in 2018. Assuming the preferred stock is cumulative, how much of the $18,000 dividend will be paid to preferred shareholders and how much will be paid to common shareholders? Well, if it's cumulative, that means even though they didn't pay in 2017, there's no obligation to pay any dividend. But if it's cumulative, you can't pay to the common until you pay the preferred 2 years. So you have to pay them for 2017 and 2018. Now there are 1,000 shares of 100 par value, so we're talking about $100,000 of shares. Okay, this goes right in the garbage. Thank you. 100,000. That one goes right in the garbage. Okay. There's 100,000 of shares, and it's 6%. So that means each year, how much do they have to pay?
And then the 6,000 remaining for the common shareholders, right? So 12,000 for the preferred.
Well, yeah, but you're a genius, so you can do it very fast. So that's $6,000 a year that the preferred share is entitled to. Since it's cumulative, they're entitled to twice that, so that's 12,000. And so that's the answer, 12,000 preferred shareholders and the rest of it the common shareholders. So the answer is C. Okay, questions? Yes? 214, that's easy. Both cash dividends and stock dividends reduce total liabilities. Well, stock dividends have nothing to do with liabilities, so that's ridiculous. Reduce total stockholders' equity, no, because stock dividends don't reduce stockholders' equity. Stock dividends, what's the entry? Debit retained earnings, credit common stock, credit APIC. Reduce retained earnings, yep. That's the definition of a dividend is debit retained earnings. And reduce total assets. No, stock dividends have nothing to do with assets. So the correct answer on that is B. Any other numbers near here, so we don't have to go fool around. Any other numbers near 213, 214?
The difference is between cash dividends and stock dividends?
Yeah, cash dividend is we pay out a check. That's a check. We send them a check, cash. Stock dividends, we give them stock, which is nonsense. We just give them more shares, but that's like inflation. So now, yeah, everyone has more shares, but there are more shares outstanding, so percentage-wise, no one has gone anywhere. So cash dividend, they get a real check, cash. Stock dividend, they get our shares, but what? The shareholders. The shareholders either get cash and a cash dividend or stock dividends and a dividend. Okay, yes. Near these numbers.
209.
209. Okay. Date, beginning inventory price at is, probably what is, gross profit using the LIFO cost assumption. What is gross profit? Okay, we started out with the beginning inventory of 20, we purchased 15, we sold 25, and we purchased 20. What is the gross profit using the LIFO summary? So on March 11th, we sold 25 at 7. So that's 175, right? Yeah, okay. And now what are the costs? Well, if we use LIFO, this problem is not 100% clear whether they're using periodic LIFO or perpetual LIFO, okay? Periodic. So they're using periodic. So that means at the end of the year, we use periodic. We say, which ones did we sell? We sold 25. So we sold these 20 and 5 from here. So we sold 20 at 4 and 5 from the previous, which is 3. So that's minus 80, minus 15, minus 95, and I get 80. I did the math right, and there it is.
What's the difference if you make the perpetual?
If you use perpetual, then you would say that 25 was 15 from here and 10 from here. Then I do that. Perpetual LIFO is not used much. The reason it's not used much is it doesn't make any sense. In other words, one of the advantages of LIFO is that you cut your taxes and things. So perpetual LIFO is just an awful lot of bookkeeping to get you into a worse position and doesn't give you the flexibility. Periodic LIFO lets you play a lot more games, it's cheaper to do. So there would be no real reason to use a perpetual LIFO method. So, but this should say periodic LIFO. Yeah. Yes? 226. Lower excerpts from the interest table. Column 3 is an interest table for what? Okay, so what's happening here? $1.08. Next year is $1.16 and change. That means what? It's the interest, another 8% plus the interest on the interest, plus another 8 and change. So every year we're adding $8. So that's like looking at $1 in the bank and watching it grow at 8% a year compounded, right? That's what column C is. So is that the present value of $1? No. Is that an annuity? No, it's not $1 each year because it's only $1. Is it the future value of 1? There it is, B. That's the only answer that makes any sense. Yes? What? 209. 209. Beginning. Yeah, we did that one. Yeah. Where did the 5 come? We sold 25. So we sold these 20 and the other 5 we sold it from here. Yeah.
How do you determine that it's not like 15 from there and then another 10 from March?
From here? You,
15 from March 7th.
LIFO, it's like coal. So that means we bought, then on top of that we put this, and on top of that we put this. So we sell 25, we sell the ones on top, the coal. So we sold, these are all the way on top, the 20, and then 5 from here. Because it's like coal. Right, it's like coal story in the lecture. Yes?
235.
235. Since we're short on time, let me handle these, okay? Okay, 235. ABC has defined current assets, cash, receivables, other current assets. ABC has defined liabilities. That's covered in the discussion board. Next. I'm pretty sure it's covered in the discussion board. Yeah? 237. Truman Company sells a large number, Staples sells a small number of expensive items. Okay, so this is Truman Company selling a large number of common household items. You picture your major chain. Stapleton is selling a small number of expensive items. You think of Tiffany, okay. The two companies report the same dollar amount for ending inventory, gross profit of the year. Which of the following most likely be true? Well, if they're having the same ending inventory, the same gross profit, what's happening? Truman doesn't make that much. Let's say one of the chains. So they keep selling a lot of them, and they make a little on each one, but they sell a lot of them. While the second company, Stapleton, sells a few of them and makes a lot of money on each thing that they sell. So Truman has a higher inventory turnover, yeah. And a higher gross profit ratio, no, there's no way. If they had that, they would have to have more. So that's ridiculous. Do they have a higher inventory turnover and Stapleton has a lower gross profit? Well, that's the same thing as this. So that's the same ridiculousness. By the way, whenever you have two answers that are exactly equal and there's only one right, then those have to be wrong logically. Because if this were true, then that would be true. Truman has our inventory ratio and Stapleton has, yeah, that's it, C, okay? And the other one, Stapleton has a higher inventory, is ridiculous. Okay, yes? 229. 229. Where do we put gains on losses on the treasury stock? Hey, what's the problem? Yes. 218. When bonds are issued at a discount and the effective interest of amortization, at each subsequent instant payment, the cash paid is more than if the bonds are sold at premium. Okay, the cash paid has nothing to do with the discount or premium. So the cash paid is more if the bond, no, is equal to the interest expense, no, less than the interest expense, greater than the, it's one of these. Okay, right away, the only two that make any sense. Now, if it's sold at a discount, that means that they got less. So they issued 100,000 bonds and they got, let's say, 90,000. So there's going to be an additional interest expense besides the cash interest that they're paying as they amortize that 10,000. So that means the interest expense is going to be more than the amount of cash they're paying. So the answer that the cash paid is less than the interest expense because the interest expense is more because there's that 10,000 extra that you only got 90 and at the end you're going to have to pay back 100,000. So there's an extra 10,000 interest that's going to be paid in cash at the end of the deal. So that's why the answer is C. Next. 219. The lower of cost and net realizable value rule causes loss of value inventory recognized in the period when the value falls. The value inventory declines cost to cost. That's right. A, by definition. Yes. Yeah.
204.
204. Which of the following would result in an increase in the current ratio, but not necessarily the asset test ratio? Now, what is the current ratio? The current ratio is current assets over current liabilities. What makes that go up? Either current assets going up or current liabilities going down will make that go up. Okay? Increase in current assets. There it is. Okay, we go home. An increase in, but not necessarily the asset test ratio. An increase in quick assets will, yes, it's going to make the current asset ratio go up, but will also make the quick asset ratio go up because quick assets are going up. So that's wrong because of B. That's close. So a decrease in current liabilities will always make both of them go up, and a decrease in current assets is ridiculous. So A is the correct answer. That's a nice, tricky question. What? A. A is the answer. Because an increase in current assets will certainly increase the current ratio, but it may not necessarily increase the quick asset ratio. For instance, if inventory goes up. If inventory goes up, then the current ratio will go up, but not necessarily the quick asset ratio. Next.
262.
262. 262. Da-da-da-da. Okay, read that. What is the total amount of plant, property, equipment, assuming the accounts above reflect normal activity? Oh, I'm not going to do that. You just got to figure out the assets, liabilities, and owner's equity and plug it in. You know, like you need a lot of fingers for that. There are no conceptual issues here. You've got all the accounts here except for plant, property. You have plant. Wait. You have equipment, and you don't have plant. You have land. So you need land, equipment, and I assume plant is missing, right? So just set up assets equal liabilities and owner's equity. Is that what you have here? No, you don't have owner's equity. I'm sorry. This is liability, assets, 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 liabilities, assets, assets, assets. I'm sorry. So they were just asking for a list of the plant, property, and equipment. So they want to know the plant, property, and equipment. What's plant, property, and equipment? Land, 90. No. Equipment, 8. 98. No. No, no. Patents, is that going to plant, property, and equipment? It goes into other assets. What's the answer on that? 98? Is 98 an answer? I would say A. Is that the correct answer? See if I got it right.
Yeah, no, it is.
It is? Okay. Because that goes into other assets. So they're just looking for plant, property, and equipment. That's it. Yes?
242.
242. ABC and the bonds. The bonds have a 10-year payment and pay interest semi-annual during the each year. Flows a partial bond amortization for the bonds. Okay, they issued 10 million bonds. They're paying 300,000 interest. That's every half year. The interest expense we notice is more than that, which means that the bonds were issued at what? At a discount or at a premium? If the interest expense is more than the cash paid, that means they must have issued it at a discount, right? We discussed that a little earlier. Okay, increase in carrying value, there it is. And there's a proof, because they issued 10 million bonds, the carrying value starts at a discount. So, of course, they issued it at a discount. Okay, what is the stated annual interest rate on the bonds? In other words, they're paying, so you don't need all this information, it's a little waste of time. They're paying $300,000 cash on 10 million bonds, so they're paying 3% every half year, so therefore, what's the full year interest? 6%. Yeah. Any questions on this one? Any questions on one? No. Okay, next one. 2, 5, 6. When we purchase a few shares of another corporation, what is the effect on our stockholders' equity? Well, when we buy shares of another corporation, a couple of them, what do we call that? Investment, and and so that's credit, cash, debit, investment. What does that have to do with our equity? Nothing. It's like buying an asset. That's it. Yes. 266. ABC reports net incomes over the year 65 months respectively. Return on equity is 10%. What is your equity? Well, what is the definition of return on equity? Return on equity is net income over owner's equity, right? That's return on equity. And we know the return on equity they're telling me is 10%. And they're telling me that net income is 65. So 65 over question mark is equal to 10%. Multiply this out and you get 650 or something. Okay, simple algebra. Yes, or as I call it in the lecture, advanced calculus to solve this, Yeah.
272.
272. If management can estimate the amount of loss that occurred due to litigation, they can estimate it, okay? And the likelihood of the loss is reasonably possible. It's a rule. It's a specific rule. Then it's if it's reasonably possible and it can be estimated, then reported as a liability. That would be ridiculous. So it's either disclosed and reported as a liability, disclosed and not reported as a liability. I forgot reasonably is what? Which is it's either B or D. D? Reasonable, not probable. Probable would be reported, and that's a rule. That's it. Yes?
243.
243. ABC purchased equipment. The equipment is expected to have a 5-year life with a residual of 5,000 at the end of 5 years. Using the double declining balance, how much is the depreciation for? Well, the double declining balance, what do? You say it's got a 5-year life, so you take 40% of that. 40% of that is 60,000. 40, say a 5-year life, 20% would be 12. 20% of that is 1/5 of 60,000 is 12 times 2 is 24,000 in the story. B. What?
Is it always 40%?
No, it's 5-year life, so it's 5-year life is 20%. Double that, 40%. Double declining balance.
Wait, but why are we
How
double?
about residual?
The equipment is using the double declining balance method. Double declining balance means double the straight line method.
Residual value in it?
What?
You don't consider the residual value in it?
I do when I get to the residual value.
Did you write out the equation?
There's nothing to write. It's 1/5 times 2 is 2/5. 2/5 times the cost times the balance. The balance of the first year is 60,000. That's the equation. 2/5 times 60,000. Next. 151. Okay, I guess we're moving down to the 251 or 150? 150. Anyone, anything else in the 200s or yeah? 269. ABC reports a receivable turnover ratio of 14.5. The industry average is 10.7. What does that mean? That they are churning their receivables and collecting it much faster over the year. What most likely is calling the difference? They got superior products and services. Has nothing to do with collecting receivables. They allow their customers too long to pay. No, they don't. They break their knuckles if they pay late. ABC has effective procedures relating to selling goods on account. No. ABC is selling to high-risk customers. No. Their turnover ratio is 14.5. I don't like any of those answers. I think they're all wrong. No? 2.6. And they have effective procedures selling goods on account. They have effective procedures on collection, not on selling. I guess 269, that's a horrible question. 269, but see, it's effective procedure relating to collection, not to selling, so I would have rejected that. Certainly if collection were one of the choices, C would be wrong. So, okay, it's a poorly worded question. Yeah, and you know, in 370 questions, you can have some losers. Yes? 265. ABC sells soccer goals over the internet. History has shown that 2% of the goals will need repair in the warranty program. For the year, they sold 4,000 goals and 45 have been repaired. Okay. The estimated cost of repair is $200. It costs them $200 to fix one of them. What would be the warranty liability at the end of the year? Well, they estimated 2%. So if they estimated 2%, they estimated from the 4,000 they sold at 2%. So they estimated 80. And it cost them $200. So they estimated it would cost them $16,000. But it turns out that 45 been repaired at 200, so that's $9,000. So they had 16,000 as their estimate. Their actual is 9. Subtracting, you get 7,000. Here it is. Questions? Yes.
Number 1.
No, I was just doing ones near around here, 200, so we don't have to float around. What? 264. That's a good one. It's right next to this. The physical inventory account is necessary to calculate the cost of goods sold. Okay. In perpetual inventory, no. In perpetual inventory, I don't never need a physical count unless there's a mistake in the records. So, but non-periodic, that's ridiculous. And neither periodic nor, but no, in periodic, how am I going to calculate the cost of goods sold? In periodic, I must have a cost to account. In periodic, but yeah, that looks right. C. C is correct. What? 263. That's a good one also. 263. Inventory records are the following. They have the opening inventory, they have a purchase. Okay. ABC sold 700 units of inventory a month. Ending inventory is in LIFO. Again, we got 500 on the bottom, 400 on top. We sold 700, so we sold the 400 on top. Then we sold 300 from here, so we're left with 200 from there. What happened? 200 from here. 200 times 240 is 480. There it is, A. 480. Okay, this is straight out of LIFO. Yes?
229.
229. Any other questions on this? Okay, 229. By the way, if you notice, when I speak over here, I speak at a much different speed than I do when I give the lectures. When I give the lectures, you know, like I specifically, you know, speak very slowly. Your final will be at this speed. Your final is going to be at this speed. It's not going to be the lecture speed. You will not have that leisurely, oh, let me read this through carefully and think about this carefully. You won't have time for that, I promise you. Okay, 229. That's it, 229, that's the question? Yeah? 229? 229, where do we put we did this already. Next.
278.
278. $278 in a stock dividend. In a stock dividend, it's debit, retained earnings, credit, common stock, APIC. Assets don't change, assets don't change, liabilities don't change. See, that's it, finished. Next. 215. Beginning inventory, ending inventory purchase. What is the average days in inventory for the year? Oh, okay. Yeah, what's the formula for that? You take the beginning inventory and the ending inventory. So the average inventory is 125. And the purchases are 310. So take 125 and the 310, and that means the turnover is about 2.5, roughly. And multiply that by 360. Is that right? No, that's not right. Divide 2.5 into 360. Divide 2.5 into 360. And 3 into 360 would be 120, somewhere between 120 and 180. Somewhere between 120 and 180. I would say 152.
Well, just first find the cost of goods sold is 360. Divide that by your average, and you get 2.88 as your turnover. And 365 by 2.88 is 126.7 days.
So I'm wrong. Okay. Good. Thank you. Okay. C. Notice, by the way, how I try and I don't want to sit there and with a calculator do it exactly. So I did a rough estimate and got it wrong. Yes.
239.
239. Easy buyer doesn't signed a 6-month note bearing interest of 12%. Principal will pay full maturity May 1st. In connection with the notes, how much interest expense should they report in 219? Well, in 219, they have how many months? January, February, March, April, 4 months. Okay, so we're talking about 4 months. The interest rate is 12%, so we're talking about 4/12 of a year times 12% times the principal. The principal is 100,000. So that's 4% of 100,000, $4,000, and the answer is A.
Just one question on this. So
Yeah.
even though the loan is only a 6-month loan, the interest percentage that they're giving, the 12%, that signifies for the year.
As I mentioned in the lecture, that anytime anyone ever gives you an interest rate, it means annual, except when it's your loan shark on the street. They mean weekly. When they say 1% interest, they mean a week. They don't mean a year. But everyone other than the loan shark, any bank, financing company, anyone that's subject to government regulation, anyone that's not trying to hide from the cops, when they say an interest rate, they mean an annual rate. Yeah. Correct. It's like, certain things are assumed. I never figured out when I look at a real estate ad and it tells you how much it is per square foot, is that a monthly rate or an annual? I guess everyone in real estate would know right away what it is, but people who are not in real estate don't know it. But, interest rate, you have to know, means annual without saying so. Yes. No, you right here, yes. Yeah.
206.
206. Net income shares outstanding stock price. What is the PE ratio? It's price over the PE ratio is the price earnings, the stock price. What is the earnings per share? The earnings per share, well, they got $150 of 300 shares. How much is the income? 50 cents a share. So it's price $20 over 50 cents is equal to 40. 40. Yes. 323. Someone purchased entire business Southern, including all assets and life insurance, below the information related to companies, no than Southern. How much is the goodwill that they pay? Okay. So they paid $600,000. The thing is that in the famous rule when you buy a company is you get what you pay for. So therefore you pay for what you get, right? So what do we know they paid? How much did they pay? They paid how much? $600,000. So they paid $600,000. They must have gotten $600,000. So we say, okay, we only care about fair values. We don't care about reported. And who did they buy? They bought Southern. So they bought 8,000 assets minus 300,000 liabilities. They bought 500,000. So you say, yes, they must equal. You say, well, they don't equal. Well, if they don't equal, then what do we have at the bottom of the suitcase? Goodwill. How much goodwill do we have? 100 of goodwill. Okay, B. Questions on this?
Questions, we just completely ignore reported assets or liabilities. We only
I
focus-
wouldn't say, for these questions we completely ignore. For a question that asks you to calculate goodwill, we ignore it, but I'm sure I could create a question that you'd have to use the book value. But it probably wouldn't be in this course. It would be in advanced accounting where you have to know how to adjust, because when you actually consolidate, you actually start with the book values. So you have to take the difference between the book and mark and add it. So, but it's, so you're asking me not a conceptual question. You're asking me an exam type question. I don't answer those.
Than what the market
They
value.
paid less than, did we discuss it in the lecture? I don't remember if we discussed it. The old rule used to be that you write down all the non-current assets except all the non-current assets. And then if you still need more than that, you go into negative goodwill. But I think they changed the rule and simplified that, or is that still the rule? Do you remember what the rule is? I used to teach, what's the rule when they pay less? The rule is you write down the non-current assets, right? That used to be the rule. You write down the non-current assets. But that's done in an advanced accounting course. What?
Not a gain.
No, it's not a gain. Oh, no. It's not a gain. You have to realize something. Okay. Remember when I start the lecture, I talk about hard numbers and soft numbers? Remember that? Okay. The reported numbers means the book values. Those are hard numbers. They're on the books. The fair values are flexy. Those are nice soft numbers. Management can play all sorts of games with these fair value of assets and liabilities, which they do. They actually do. This is one of the favorite places to play games because no one catches it. You can't get caught with anything because it's a very soft number. If you're going to call that a gain, they can write their income statement because they'll just manipulate these numbers to get the gain. Okay, if you want, you can read, if you're at all interested in this, read someone, former professor here, Abe Brilloff. He's not alive anymore, he died a few years ago. He wrote a whole bunch of books about this, about the dirty accounting that happens in this. As he called it, he didn't like calling it GAAP. Remember GAAP, generally accepted accounting principle? He called it cleverly rigged accounting ploys. And I'll let you figure out what that stands for in your free time. Yes, next question. Yeah. 201. 321. 321. Ah, that's the real new. Leverage. Leverage means what? Instead of investing my money, I borrow money and therefore invest in it. So what happens? When things are good, that's great because I pay off my interest and I get phenomenally rich. That's how people get rich with leverage. The problem is that if I earn less than I expected, I can't make my interest payments and I die very fast. So that's what leverage does. So let's see what says that. Does it increase the maximum returns? Yes. Decrease risk? No, it doesn't decrease risk. It increases risk. Does it increase the maximum returns? Yes. Does that say the same thing? A and B are the same? Okay, that's dumb. Increase the return and increase risk? Yes, it does. C. Okay, so C is the correct answer. B is a stupid choice. And well, then you knew that A and B had to be wrong because of, but anyway, you can figure this one out. Okay. Yes? 333. That's an interesting number. Okay. A balance sheet. Provides a future distribution, yes. Provides a snapshot of present assets, yes. Provides a history of source of assets, yes. C, yes. D, all of the answers. Straight definition from the lecture. 340. Gross profit ratio will typically be higher for a company that makes more of a profit on each unit they sell. Person will know, collect cash will know, sell products that are more highly specialized, yes, because they're more highly specialized, they can mark it up more. In other words, if you're competing, and from your economics course, if you're competing with 17 other grocery 17 other chains selling the same medicine, you can't mark it up much because everyone else will go to the other stores. But if you're selling something that's highly specialized, like you're the drug company, so when you sell this drug, no one else has got this drug, oh, can you mark it up? You're going to have a much higher gross profit ratio. And so grading units have nothing to do with it. So the answer is C, and there's an important lesson there about economics. 324. 324. Find financial savings coming. What are the amount of long-term assets, assuming a long-term asset, just add up the long-term assets. Land, 90, equipment, 98. 98. Patents, I'm sorry, 98 and 75 is 173. Next. 325. Which ratio is strongly influenced by long-term debt of a company? Long-term debt of the company means that anything with, one of these leverage ratios should have an effect on it. Let's see. ROE, return on equity. Neither ROI, both ROI. ROI is return on investment. The return on investment, and that has nothing to do with, return on investment is just net income over total assets, right? So that shouldn't have much effect on it. I would say ROE, 325A. Did I get it right? I got it right, okay. I'm doing pretty well. I think I've passed the course. Yes? 327. The balance sheet is over 400 and 450 at the beginning and ending respectively. Turn as of the year is 10. What is the net income? Well, the average of that is 425, and that's 10% of what we're looking at, so multiply by 10 and you get 4250. B. Next. Yeah.
342.
342. ABC should call Bob on to project the flying amortization table of the material. Blah, blah, blah. Okay, now it's the callable bonds, and it keeps going up, so it's going from 194 to 200. They sold it at a discount, and fine. Okay, ABC buys back the bonds for 196 immediately after the payment on 12/30/18. Right over here, when the bonds are 196,370, they buy it back for 196 and retires. And what gain or loss? Well, if I reduce the liability by 196,370 and I pay 196, I must have a gain of 370. 370 gains. See.
Go back to 327, please.
327. Yeah. 327. I said the answer is B. Yeah.
No, it's A.
It's A, right? The 10%.
I'm sorry, return on what is the net income? Fine, yeah, sorry. A, 42.5. Got another one wrong. Yes, 42. Thank you very much. Okay. I would give you an extra credit point, but I can't because all the people who didn't show up today don't have an opportunity to get it, so it's not fair to them. So if not, I would have given you the extra credit point. Yes. What? 362. 3 what?
262.
262, okay. What is the, we did this. We did it. Next.
337.
327? 337. Classification on the balance sheet, the section. All classification with the general ratio for the section done in the statement cash flows. Indicate which relation is correct. In other words, where do these go? Bonds payable, do bonds payable have to do with what? Bonds payable, when we borrow the money, it's a financing option. We pay back, it's a financing option. So 1 is correct. So, okay. Equipment is not operating. Equipment is investing. So 2 is wrong. So the answer is B, finished. Right? Since 1 is correct and 2 is wrong, I don't have to read the other ones, so I don't waste my time doing it. Yes?
335.
335. A company mistakenly records the cash purchase of the land as an expense. In other words, we were supposed to, when we buy land, debit land, credit cash. We record it as an expense, land expense, instead of debiting the asset land. As a result of this error, what's going to happen? Well, we're going to have too much expenses and too little assets, because it should be asset, and instead we have expenses. So we understated the assets and overstated the expense. Understated the assets and overstated the expenses. No. So understated the assets and overstated the expense, which means equity is understated, and the correct answer is D. Questions on that? Yes? 201. 201. No, you just page it down, and that's the only way we're going to get there. 201. There are too many of them because that's the year. Okay, there we go. We're almost there. 201. For a journal entry with only 2 lines. Oh, the fine. Gee, you just got to know debits and credits. You say increase in liability is a debit or a credit? Credit. A decrease in dividends. An increase in dividends is a debit, so a decrease in dividends is a credit. So the question is a credit and a credit a good answer? And what's the answer? Is that a good entry? The answer is no. Yes. 190. ABC reports dividend per share $1.40 and net income for $150. The current stock price is 40. What is the dividend yield? Dividend yield means the dividend that I get over the stock price. So you just take the dividends of $1.40 and the stock price is 40, $1.40 over 40, multiply by 2.5, and you get 28 and 7, 35, 3.5%. B. Okay? Questions? Yes? 350. 350. Warren Buffett is most interested in buying ratios. Does he care about your working capital? He couldn't care less about your working capital. That's not important. He has all the capital he wanted. That. Does he care about return on assets? Oh, that's what he wants to know. Because your assets, how well are you utilizing your assets? That's the only thing he really cares about. Earnings per share, he knows you can manipulate this from today till tomorrow. Return on equity has to do with the debt ratio. He has no interest in that whatsoever because he's going to restructure. What he cares is how good are you at, if I give you $1 billion, what on earth are you going to do with it? Will you do a good job or not? I'm not interested in all the games that you play. I want to know that. That is his only rule, return on assets. Yes?
343.
3-4? 3-4-3. 3. ABC purchase is going to cost 20. It has to be like 4 years, no residual values. We're going to depreciate if a straight line method was sold at the end of the 3rd year for 25 cash. Very good. Okay. Well, it's 120. It's got a 4-year life. How much should they depreciate each year? 30,000, right? So depreciate 30,000. So after 3 years, the book value is going to be 120 minus 30, 30, 30. So there's 30 left. Okay, so the book value is 30. They sold it for 20. They got a loss of $5,000 D. Next. 350? 50? Okay, we can go to the top. 50 and then just shoot down. There we go. 50. Okay. On February 26th, we're going to issue $25 cash. On March 15th, the company reissued. So what do we call that when you acquire shares? That's called treasury stock. On March 15th, they're going to issue 70 of the shares at $3 each. What is the true of the entry for reissuing the shares? Well, okay. How many shares? The company reissued 70 shares, so we're getting how much We're 2,100. So we bought them at 25, those 70 shares. So we bought the 70 shares at 25, and that's equal to 1750, right? So we paid 1750 for it. We reissued it for 2,100, which is quote unquote a gain of 350. So where do gains go? APIC 350.
What?
70 shares of 25. 70 shares, 25.
Like, they acquired 200 shares.
But the other 130 we didn't do anything with, so we're not interested in that. We're only interested in the 70 that we reissued. We're looking at now that I reissued 70 of these, what happens? So we're not looking at the 130. Yeah, we required them on February 22nd, but we're asking what happened on March 15th. What's the entry for reissuing the shares on March 15th? All I care about the 70. I don't care about the other 130. The other 130 are irrelevant. Yes?
84.
84. AB's are the following current assets. Under the receivables inventory, other current assets, the following liabilities. Current, based on what is the asset test ratio? It's just, you know, the asset test ratio is cash 102 plus receivables 94. Accounts payable 90. This is discussed in Blackboard. Anyway, that's the answer. Okay. It's in Blackboard. I remember discussing this with someone. Okay. So the answer is it's about 200 over 98. It's a little over 2. It's about 2. Okay, 2. 196 over 98. 2. Yes. 24. Wait, do you want to go back to that one? Which one is that? 84, yeah. What are we waiting for?
Not, yeah, I mean, no, that's.
What is the asset test ratio? Is the current is the cash of 102, receivables 94 million is 196, and I don't think so. I think it's 98. Yeah, how would you know that the answer is B? Are they taking the long-term portion of the debt? Yes, they are. One question does use it, and the other one doesn't. They're adding the 35 and getting that. Okay. I don't remember whether the long-term debt, whether the current portion of long-term debt is included. Remember what I taught you, that the question is sort of an unfair question because I can define the asset test ratio any way I want. This is not GAAP. There's no GAAP on ratios. Ratios are what I create to analyze. If I want to include it, I can include it. If I don't want to include it, I don't include it. So this is a poor question. And it's discussed on the Blackboard, and it's poorly discussed there, because there it's the opposite conclusion. Because as long as I'm consistent, I will get an intelligent analysis. So whether you include it or not, bad question, shouldn't be here. Okay, yes?
Final, will this question and the other question you did not like, will those be on the final?
It could be.
So we should memorize B, not D?
You'll get it wrong. do you know how much a question is worth on the final?
Like half a percent.
Yeah, it's somewhere between half, it's less than 1%. So it's less than 1 point. How much is the final worth on your grade? 30%. So we're talking about 30% or less than a point. Yeah, right, okay, right. If, you know, it's life. Hey, you know, remember, this is an important lesson that you learn in the modern age. In the modern age, if you want to succeed in business, you do not strive for perfection. If you strive for perfection, By the time you're perfect, you will be dead in the water because there's some business that already owns 90% of the market. What you do is you come out with a pretty lousy product that's reasonably good, and then you iterate and improve it, and iterate and improve it, and iterate and improve it. You know, think what Google looked like when Google started compared to what they are today. They didn't have 1% of the capacity of what they're doing today. I remember using them, but they were a little better than everyone else, and then they started getting better and better. So we're not trying in these 370 questions. And this semester is 370 questions. Next time I teach, I'll try and get it up to 800 questions. So there'll be more. I'm not trying to get every one of these questions to be perfect. Yeah, you know, if there are a lot of lousy questions, okay, then I'll put in a curve. But you know, I'm not worried about it at all, so I don't feel bad. The truth is that the definition of quick acid ratio is not gap, so you can do whatever you want. And therefore, the question is sort of a little unfair. Shouldn't have asked that much detail if I wanted to. Dumb question. Okay. Doesn't bother me. Yes? What? 7-7. 7-7. Unearned revenue is a liability. It's a unique type of liability account. That's it. Hey. Next. It's not regular because normal liabilities I have to pay in cash, and unearned revenue I don't have to pay in cash. What's going to happen is that I owe them services or a product. So that makes it different than everything else because I don't have to pay it in cash. And there's no interest on it. In the lecture I go through, I think, 5 reasons why it's different. Yeah.
75.
What?
75.
75. Which is easier to calculate? A firm's cash flow or a firm's net income? Cash flow or facts? This is fairy tales. So what's easier? Facts are easier, fairy tales, first lecture or something. Yeah?
51.
51. The answer is cash flow is easier. 51. How many types of inventory are in the factory? Well, in the factory, what do you have? You got your raw stuff and you have your work in process. You do not have finished goods because finished goods are immediately shipped out of the factory. So the answer is 2B. Yes?
24.
24. During that, they define cash flows. They received cash, they earned, they paid interest, they paid dividends, they borrowed, they purchased. What does AB say? Net cash flows from financing. Oh, okay. Just look at the things that have to do with financing. 1, that's operations, ignore it. Income, that's operations, ignore it. Paid interest, interest is an expense, so that is considered operations, that's ignored. Paid dividends, that is a financing activity, right? So 8 down. Borrowed 40,000, that's financing, that's 40 up, so we got 32 up. And purchased its own shares for 10,000, that's minus 10, that's 22. 22. Okay? Hey. Next. Yeah.
28.
28. When we sign an executive contract, generally, an executive contract means I promise, you promise. What do we do? Nothing. So since we did nothing, what entry do we generally make? Nothing. So look for the word that says nothing. C. Yes.
12.
12. Can a firm earn 36% risk-free? Yes, by paying after the sales discount period. Yes, by paying within the sales, and no. Yes, by over. And the answer is yes, by paying within the sales discount period, they earn 36%. They get 210. That's sexy. Yes. The answer is B. If you pay after the sales discount, you lose the discount, so you don't earn anything. Right. The answer is B. Yes.
8.
8. By the way, most of these questions are pretty good, aren't they? For 370 questions. Yes. Research and development costs should be capitalized when? Research and development costs in America are never capitalized. So the answer is, I don't even have to read anything. D, none of these. It's never capitalized. It's always expensed. Yes?
D.
9.
9. ABC person going to go had an estimated life 5 years, no residual value. The company by straight line was sold at the end of the second year, 5,000 cash. Okay. If it has an estimated useful life of 5 years, that means 2,000 depreciation every year. So after 2 years, how much is the book value of the computer? 6,000. They sold it for 5,000. They lost $1,000. So they got a loss of $1,000. C. Yes. 3. ABC purchases inventory incurs shipping costs of $100 goods to be delivered, freight out. Okay. To record this transaction, the company debits inventory. Oh, I'm sorry. That's freight in because they're buying it. I'm sorry. They debit inventory $2,000, debit selling expense for $100. What? Wait a second. They purchased inventory, incurred shipping costs of $100 goods to be delivered, meaning to their customer. Okay. To record this transaction, the company debits inventory for $2,000. Debits selling expenses for $100 and credits cash for $2,100. They sold it for $2,100. But what's wrong with this? The answer is what? But what's happening is as follows. Is this to record this transaction of purchasing the inventory? This is so poorly worded, I can't understand it. In other words, we bought the inventory, we incurred shipping costs to be delivered to us or to someone else? To us, okay. So that means we bought it, okay. So what is the correct entry on that? The correct entry on that should have been debit inventory $2,100 and credit cash $2,100. Okay, that's the correct answer. When we buy inventory and pay $2,100 shipping, that's the answer. Okay. Now, the idiots did what? They debited inventory $2,000. Okay. So that's okay. They got $2,000 right there. But then they said selling expense of $100. No. That should not be selling expense. That should have been put into the inventory. And they credited cash right. So what happened? Inventory got understated by $100 and expenses got overstated by $100. Okay? Now we got the facts of what's going on. Okay, so now we look at the answers here. Net income is overstated. Well, if you overstate expenses, no, net income is understated. Assets are understated, yeah, because the inventory is down 100, so B is correct. Revenues are understated. This has nothing to do with revenues. All accounts are accurately stated. No way, I couldn't even figure out what the question meant. Yes, any questions on this?
Do you ever not include shipping as part of inventory?
Yeah, when I freight out. Freight out is the selling expense. In other words, what they did was they treated the freight in as the freight out. That's the dumb thing that they did here. So they treated it as selling expense, which is wrong. The question could have been worded with made it a little clearer what was going on. But yes. 4. ABC spends $50,000 this year in research and development for a new drug to cure liver disease. Oh, it's touching. By the end of the year, managers feel confident that it's going to get into a higher future. What impact will it have on the year financial statement? It's expense. Finished. Increase expenses. That's what we do with R&D. It's a very touching story, though. Yeah. What? 3. 33. This year, a company made an error in its ending inventory. Okay, this year they made an error in the ending inventory. Well, if they made an error in the inventory, then the ending inventory, where's ending inventory? Let's ask that question. Ending inventory is where, on which statement? Ending inventory on the balance sheet as an asset and on the income statement, because on the cost of goods sold statement is a subtraction. Goods available for sale less ending inventory is cost of goods sold. So it is on the cost of goods sold statement. So that means the assets are wrong and the income statement is wrong. Okay, now we just look for that. Neither will be wrong. That's ridiculous. The balance sheet will be correct. That's ridiculous. This year's balance sheet is wrong. The income statement is wrong. Both this year's balance sheet and income statement will be wrong. D, that's it. Okay, good. Next. Yes? 29. Which type of inventory is in a factory? We just did that. The type of inventory is they have raw materials and work in process. That's it. Yeah?
There are no answers.
No, they're not inventory. Direct labor and over are not inventory. There are only 2 inventories. D and E. A is not in the factory. It's in the selling floor. Direct labor and overhead are not inventory items. They get thrown into the work in process. They're in here. D and E, raw materials and work in process. Yes? Yeah? 13? 13. Under the principle of lower cost and never realize, didn't we just do that? No, I don't know. Okay. No, what's the adjustment? Okay. When a company has 10 units of inventory with a net realizable value of 50 and 60, what they have to do is write down the 10 units from 60 to 50. So they're writing down $100. So if they write $100, so they got to write down $100. How do you write down? You reduce inventory, say credit inventory 100 and debit cost of goods sold expense. So it's debit cost of goods sold 100, credit inventory 100D. That's it. Yes?
39.
39. ABC something that was purchased for 700. ABC was going on, it sells even using a periodic inventory system. In a periodic inventory system, I don't keep track of the cost of goods sold as I sell it. So all I do is record a sale of 1,200, debit, all I do is credit sales 1,200 and debit either something. So no entry is required for cost. Yeah, that's A is true. And debit inventory, debit, okay, A is the only answer, so, okay. Nothing to do with anything. Yes? 7. On the summary of this on a 2005 to 6 with the amount borrowed plus according to payment 6 months later on June 1st. ABC records the report on December 31st. What amount of cash will he need to pay back the note payable plus any accrued interest? Well, this is a cute question. They're asking, what am I going to have to pay back? Well, what do I have to pay back? I couldn't care less what entries they made. What do I have to pay back? The interest for 6 months. So 5% for 300,000 would be 60,000 for a year, and so for a half year it's 30,000. So they're going to have to pay back. They'll have to pay back. What did I say? 5% times 30 is 15,000. So half of that is 7,500. So they have to pay 300 plus 7,500, and there it is. 14. Which of the following is a sign that a company can quickly turn its receivables into cash? Quickly you turn it into means they're turning it over very fast. They quickly turn the cash. Both the low receivable turnover, a high receivable turnover ratio. There it is. Finished. The other ones were all ridiculous. Okay, B. Yes?
42.
42. Which of the following is true regarding the relationship between the current asset and the asset-based ratio? The current ratio will always be equal or larger than the asset. Yeah, that's true. It's got to be because it includes inventory, which is either 0 or positive. You don't have negative. A sounds right. This is ridiculous. This is ridiculous. And either, no, okay, A is the only one that makes any sense. The other ones are ridiculous. Yes?
40?
Yeah.
58.
58. Okay, we're at 40. Okay, so you're next, 58. Which statement is true? In both plans, meaning the defined benefit and a defined contribution. In a defined contribution plan, what happens? The company contributes a certain amount to my pension plan and then I invest it. If I invest it wisely, I retire well. If I invest it stupidly, then I don't retire. So all the risk is mine in the defined contribution plan. In the defined benefit plan, if the company doesn't go broke, they are guaranteeing me a certain amount, so I have no risk, except that they may go broke. In both plans, that's ridiculous. In a defined benefit plan, the employer has all the investment risk, yeah, because they're going to have to pay out the fixed amount. The defined contribution plan, the employee has B is correct. That's it. Definition. Yeah. B. Next was 50. 50, 50? 58? Okay. A bond issue with a face amount of interest is 7%. The current market rate of interest is 6%. These bonds also have a price. Well, if they're bearing an interest rate of 7%, that means they're promising to pay 7%. But the market is happy to accept 6%. So if I'm going to give you a $500,000 bond and pay you 7% interest on that, you're going to end up paying me more than $500,000 for that privilege, right? So I'm going to sell it to you at more than $500,000. So it'll be sold for more than $500,000. B. Yes?
For number 15, it's a premium though.
In 58, it's being sold at a premium, correct? Yes? 61. Bond X and bond Y are both issued by the same company. That means it's the same risk for the companies. Okay, each of the bonds has a face value of 100,000. Each matures in 10 years. Bond X pays 8% interest, while bond Y pays 9% interest. So the market rate of interest is 8%. So that means the 8% bond they're going to issue at par, the 9% they're going to issue at a premium. Okay, let's see what says that. Bond X is going to, bond Y will sell for more because it's sold at a premium. That's it. D. Yes.
104.
105. 104. 104. Goodwill is only recorded by the seller of business. No, it is certainly not. It's recorded only by the buyer of business. Recorded when created internally with your advertising expense. That's ridiculous. Is amortized over the greater of its estimated life or 40 years. That used to be the rule, but that is no longer the rule, so that's gone. The value of a business as a whole over and above the value of its net identified. Yeah, that's the definition of goodwill. Yeah. So D is the correct answer. Yes. What? 107. Okay. Aggressive accounting practices produce what? Well, the way I taught it to you, aggressive accounting practices have to do with what? With the fairy tales or the facts? It's the same cash flow because the facts are the same. Aggressive accounting for facts gets you where? It gets you an all-expense-paid trip to the local penitentiary for 10 years where you get fed and you're taken care of and protected, except for your fellow inmates. But aggressive accounting practices is not good for facts like cash. But when it comes to fairy tales, then, you know, like your fairy tale and there's my fairy tale, and the fairy tales are fairy tales. You can't say someone was doing fraud. So aggressive accounting produces the same cash flow for a property. Yes. A. Correct answer. Yes.
126.
126. During the first years, ABC drove the company truck 15 and 22 miles respectively to deliver merchandise to its customers. The company originally purchased the truck for $175,000. The truck has an estimated worth 300,000 miles. With an estimated what amount of depreciation is recorded in the second year using the activity-based method? Okay, so the activity-based method is that it's 300,000 miles. The estimated residual value is 25, and it cost me 175, so I'm depreciating 150,000. So I'm depreciating 150,000 over 300 miles. You do the heavy math. You figure out how much am I doing per mile? 50 cents per mile, right? So it's 50 cents per mile. And in the second year, we drove 22,000. So 50 cents, 22,000, 11,000. And the answer is 11,000. Yes. Next.
1 second. You don't put in consideration 15,000?
What?
15,000.
15,000?
No, that's the first year.
That's the first year. What about during the second year?
Like overall.
It's asking you what is the depreciation expense. Depreciating expense always means for the year. Accumulated depreciation would be over the years. That's an asset account, contra asset account, depreciation expense, and income statement account. Okay. By the way, I think everyone here realizes that if you know the material, this review is good like for polishing up, like, you know, getting some points clear or something. If you don't know the material, you must be like overwhelmed over here, like feel like you're drowning in the ocean here, like you just. Okay, yeah.
106.
106. In doing an allocation for a basket purchase, well, you know, when we buy something, we are trying to figure out the market values of each one, but we don't have that, so we know how much we pay totally, and we somehow have to allocate that, so we use the percentage of the costs of each one. We use book value. So use the individual cost and total market value. That's correct. Use the individual. We don't know the individual market value. That's ridiculous. Use the total cost. Why would I use total cost? Use the total cost and the individual market value. So the answer is A. Use the individual cost because I know the individual cost and the total market value. That's it. Okay, that's what I have. Yes?
88.
88. Which of I is not an example of aggressive accounting practice? Recording contingent losses that are probable. No, because that's conservative because you're picking up a loss early. Increasing the useful life used in calculating depreciation. Yeah, if you increase the useful life, that's sort of aggressive because now you're going to have less depreciation, so you're taking less expense. I think B might be right. Recording research development as assets, it's looking for not an example. So again, let's start again. We're looking for an example as non-example. So this decreased expense, it is recording contingent losses that are probable. That is not aggressive. So the answer is A. We don't have to read the less. Using a lower, all these three are aggressive because they're all increasing income. Yes? A. What? 130. 130. Assuming an asset debt ratio of 1, how will the purchase of inventory with cash affect the ratio? Well, if I purchase inventory with cash, inventory has nothing to do with the asset test ratio, so that's it. So what happens? Cash, though, is going down. Cash is going down. The asset ratio will have to go down, so it will decrease the asset test ratio. See, because cash is going down. Yes?
103.
103. In a perpetual inventory reserve, the entry of time is according to the cost of inventory so includes a credit inventory debit cost of goods sold. Debit cost of goods sold, B. Yes? 105. ABC purchase equipment is going to silent. The equipment is expected to have 5 years of 5 at the end of 5 years. Using the straight line of book value, that's the end of the first year. So you're talking about $55,000 depreciable, 5-year life, so you're taking off $11,000 a year. So if you take off $11,000 a year, after a year you took out $11,000, 60 minus 11 is 49, and that's it. Yes? 108. Uncontrolled liquidations. An uncontrolled liquidation means that I'm a LIFO company and it ends up at the end of the year that I sold more than I bought, so I liquidated, and I really didn't plan on doing it. So what's going to happen is, as soon as you see FIFO companies, you say, hey, there is no such thing as a liquidation of FIFO companies, so only got to look at a C and D. Now, what happens usually in an uncontrolled liquidation, generally prices are going up, and now I am liquidating when I don't want to, so I'm taking this old inventory at an old cost and picking up a huge income, so I'll get an increase in income, and I'll get an increase in taxes. So that will increase income and increase taxes for LIFO companies. So C and D is the answer. It should say in a normal inflationary environment. Question isn't perfect, but of those choices, those are the only ones that make sense. C and D, yeah. They hang together. Yeah. 112. 112. ABC purchased equipment by paying $5,000 cash, other shipping costs to get the equipment to its factory. The fair value equipment is $7,000. For what amount should they record the equipment? What they paid for it? $5,400. 5,400 D. Next. Yeah.
140?
140. We may make it. Yeah, 140. Okay. Below are the excerpts of the interest table. Column 2 is an interest table for what's happening to. Things are going down. It looks like $1 getting worth less each year. So this is the present value of $1 is A, the answer. That's it. Okay. A. Yeah.
99.
99. Assuming a current ratio of 1 to an asset ratio of how will the purchase of inventory with cash affect each ratio? Okay. So we got a current ratio of 1.2. If I buy inventory with cash, what does that do to the current ratio? Nothing, because current ratio is just cash plus inventory, so that's no effect. So the first thing is it does nothing to it. And the asset test ratio, what's going to happen? Here, inventory has nothing to do with it. Cash is going out, so it's going to decrease it. So current ratio will be the same, asset test will decrease. So no change to current ratio and decrease the asset test ratio. A, that's it, finished. Yes?
139.
139. ABC purchased a copyright for 50,000, copyright minimum left in a year, but only an expected useful life of 5 years, no residual value. Well, we're obviously going to use expected useful life. Assuming the company uses straight line method, what is the carrying value at the end of the first year? Well, if it's got a 5-year life, so that means they amortize 10,000 a year, there's 40,000 left, and the answer is B. Yes? Yeah?
136.
130. 130? 136. AB's is developing a horse transfer device, and in good research and development goes 25. Rather than continue with their own research, they decided to purchase a patent for a similar design for $350. What are the total asset expenses of these development? $250. That's dead. That's idiotic. They're just written off $250. But what you buy is an asset, so the answer is $350. Assets $350. Expenses $250. C. Yes.
284.
84. 284. Can APC have a debit balance? No. By definition. That's called an overdose on APC. We don't overdose on APC. Next.
I know we did it, but could you explain 106 again?
106. Okay. But I won't do it as slowly as last time. In doing an allocation of a basket purchase, what happens when I buy a basket purchase, I bought something, so I know the current market value of the total. The total market value is what I paid for it. But I don't know the individual market values. I'm trying to get the individual market values because that's what goes on my books when I buy it. So therefore, what I do is I use the individual costs of each one to do the proportion to figure out what the market value is of each one. Yes? 89. ABC would call bonds and project the volume of it. Didn't we do this? Okay. No. What is the annual stated interest rate on the bonds? Okay, they're paying $7,000 on bonds of about $200,000, and this is a half year, so that would be $3,500. So twice 3.5% is 7%. That's it. Yes. 138. Lower of cost of market is based on which accounting principle? Well, since we're going lower, that's conservatism. That's it. Next. Well, let's hang near these numbers. Okay, well, any number, 342 is far away. Yeah. 137. In a periodic inventory, at the end of the time of sale, to record the cost of inventory. In a periodic system, when we record a cost, then we do nothing with cost of goods sold. So we would, the entry at times though, to record the cost of inventory, we don't record the cost of inventory. So it's not recorded at the point of sale. B. Yes? 160, 162, 162. Specific identification is used when we're dealing with non-fungible inventory items. Okay. Starbucks, do they sell fungible inventory items or non-fungible inventory items? They sell fungible, right? Every cup of coffee is the exact same thing. Manufacturers, pens, grocery stores have a car dealers. Every car is a different thing, you know, like it's very different between buying a used jalopy for $800 or buying a $250,000 car. You're obviously not going to use any of the LIFO, FIFO methods. Makes no sense. You have to match the used jalopy of $700 with what that's sold for, and you have to match the $250,000 car with what that was sold for. So car dealers are the example. They don't sell the same cars. They're not fungible at all. Yes? 151. The balance sheet of subsidiaries shows assets of liability 50. Fair value of the assets is 90. Fair value is 15. The parent company has to acquire. Parent should record goodwill and purchase. What did they buy? They bought fair value of 90 and liabilities of 15. So they bought fair value of 75. They paid 95, so they paid 20,000 extra. The goodwill is 20,000 B. Saying we did that equivalent problem before. Yes. Next. The answer is B, 20,000. 144. 144. Someone who sells milk can report their individual life. Yes, they definitely can, because this is a fairy tale. It has nothing to do with the real physical flow, so they can. The answer is yes. Next. Yes.
8 days.
What? 115? 115. 150. For which step in the operating cycle is there a difference between manufacturers and retailers? Well, what happens? What is the steps in the operating cycle? It's buy or make, sell and collect. Sell and collect are the same. It's buy or make, so it's the first step. Yes?
147.
147. Assuming current ratio of 1 and asset ratio of 0.8, how will the borrowing of cash by issuing a 6-month note payable affect each ratio? So I'm borrowing cash and issuing the 6-month note payable for the same amount. So that is cash as a current asset and note payable as a current liability. So that will increase the top of the current ratio, the same amount that will increase the bottom ratio. So it's not going to change the current asset. But the asset test ratio, I'm increasing both the top and the bottom. So if I have 0.8, you say, well, I don't know what number, so take any number, it doesn't matter. So say it's 0.8 over 1, let's say, so it's 1.8 over 2. 1.0 over 2 is 0.9, so that's going to increase the ratio. It's going to bring it closer to 1. So the answer is that it will have no effect on the current ratio, and it will increase the current asset test ratio. Yes? 151. The balance sheet shows the assets and the liabilities. The fair value asset, the fair value income base. It's the same thing. You know, we did this equivalent problem a minute ago. So yes. 164. ABC, correct ending balance. It should be 5, but the company, like idiots, stated it as 3,000. In 2019, ABC correctly recorded ending balance of the inventory, which defines 2. Well, that means in 2018, they're off by $2,000, it is. They're off by $2,000 in the inventory, and they're off on expenses. By the time they finish the next year, the thing straightens itself out. So in 2000, well, now retained earnings are understated. No, in 2019, everything's okay. So gross profit is overstated. So it's one of these three. Okay. Now, if they understated inventory, that means cost of goods sold is overstated. So this is wrong. Gross profit is overstated by 2,000. They understated inventory, ending inventory, they will overstate gross profit. So yeah, C. Okay. Next.
163.
163. If a company understates count of ending inventory euro, which of the following is true? Well, profit is great. No, that's not true. Cost of goods sold is understated. If they understate the ending inventory, then cost of goods sold is overstated, so B is wrong. The balance of retainer is correct at end of year 2. Yeah, that's true. Okay. C. Yes? 149. Using the true-by criterion, what is the ultimate goal of accounting? Predict the future of the firm? No. Predicting of the investor or creditor? No. Predicting of the investor or creditor. The ultimate goal is predict future cash flow of the investor or creditor. That's the ultimate goal. Yes? 161. ABC purchases and incurs shipping costs. We did this, no? Yeah. We did this. But we did something exactly like this. So, next. Yeah. What? 83. In January, he sells a gift card for $50 and receives cash $50. In February, a month later, the customer comes back and spends $20 of their gift on a water bottle. What would be the appropriate journal entry for the purchase of a water bottle? Okay. Well, when we sell the gift card, we have what? We have deferred revenue of $50. So when they buy a 20, deferred revenue goes down. Deferred revenue is a liability. So debit deferred revenue $20 and credit sales revenue $20 is right. That's it. Everything else is wrong by definition. Okay. Next. Right? Yes. What? 80. The year-end adjusting entry for warranties or credits. Credits. Well, in a year-end adjusting entry, what is the entry? The entry is debit, warranties expense, credit, warranties payable. So credits, warranties payable. Warranties payable is a liability. D. Next. Yes.
79.
79. Boy, everyone's going to get 100 on this exam. I have to give out all A's. Okay, fine. Doesn't matter. I'll get the, I'll get the pressure, but you'll have gotten your A, so it doesn't make any difference. And I don't care. I'm tenured, Phil. Which of the following statements regarding liquidation is true? Okay, we're looking at liquidity ratios. What is liquidity ratios? Liquidity ratios means do I have cash to pay my bills? A high working capital generally indicates the ability to pay current liability. Yeah, that's true, A. Okay. A low asset touch ratio means that we're going to die, so no, that's wrong. All current assets are due within 1 year and have equal liquidity. That's not true. They don't have equal liquidity. Inventory does not have the same liquidity as cash. That's ridiculous. And a low current ratio generally can pay current liability. No, that's ridiculous. So a low current, no. So the answer is A. The other ones are absurd. Okay.
Can you say ACY is liability and not
Could I what?
80.
80. The year-end adjusting entry of warranties credits is a liability, yeah. Why would you credit an expense? You debit an expense. You debit warranties expense, credit warranties payable. Yes, next. 81. Choose one. Okay, I chose one. I guess I mean choose the correct one. Not worded that well. Okay. Periodic inventory is less expensive than attainment. That's true, because you don't have to keep track of it. End of story. Okay. Next. 102. What is operating income? What does operating income mean? Operating income means sales minus cost of goods sold, right? Sales, 440. Cost of goods, operating, minus expenses, okay. Minus cost of goods sold is 180. So 440 minus 180 is gross margin. That's 440 minus 200, 260 minus expenses. Not interest expense, that's right. So it's advertising. Interest expense goes on the bottom of the line, right? Yeah. Okay, so 280 minus advertising expense is 220, minus salaries expense minus utility expense 220, minus 80 is 140, and income tax expense bottom line 140. I'd say 140. That's not an answer. I did the math wrong. Okay, let's try it again. 440 minus cost of goods sold. Cost of goods sold is 180 is equal to 6, 3 minus 1, 260. Okay, so that's the gross margin. Now all expense, I guess interest expense is included, that's it. So advertising expense, interest expense is 70, salary expense 70, 140, 150, and not interest expense, 150. Oh, no, the interest expense, oh, I had it right, I just did the math wrong, 140, okay, 220, 120. Got it? 120. Interest expense goes on the bottom because it's not an operating item. So it's all your expenses except for the interest and the income. I just did the math wrong.
For interest and what else?
Interest and the income tax expense. Those are not operating items. Operating items are sales minus cost of goods sold minus the operating expenses. Interest is a financing item that has to do with how much debt you have, and income tax expense is just robbery from the government. So that's, yes? 100? If a company overstates its ending balance in year one and records them correct in year two, which of the following is true? We sort of did this, but the point is that netting, if they overstate the ending balance, then they will overstate the ending inventory. And if they overstate the ending inventory, they therefore have understated their cost of goods sold. And net income is overstated in year one, so this is wrong. Cost of goods sold is overstated. What did we just say? It's understated, so that's wrong. Retained earnings is overstated. That's wrong. And net income is understated in year one. That is, net income is understated in year one because they've overstated their inventory. They have understated the cost of goods sold. I got it wrong. Okay, let's try it again. Company overstates ending inventory and of course inventory going year 2, which I find is true. In year 1, they overstated their ending balance, so therefore they have too much ending inventory. Therefore, goods available for sale, they subtract too much. Therefore, they understated their cost of goods sold, and therefore they overstated their income in year 1, which means retained earnings overstated in year 1. The other way to do this, if you don't want to do this calculation, is say as follows. If they overstated their assets in 1, right, inventory is an asset, they must have overstated their owner's equity. So if they overstated their owner's equity, where is it? Retained earnings, that's it. That's the easy way to do this instead of doing the other way. No, you can either take an income statement or a balance sheet approach. 234. ABC issues on the part of the stock at the beginning of the middle, all remaining shares of common stock. If it's non-cumulative, we just ignore what happened in the previous year. So all they have to do is 6% of 1,000. So all they have to do is pay 6,000. So 6,000 goes to preferred shareholders and 12,000 got B. Next. Next. Yeah. 226. Below X, column 3 is the interest table 4. Column 3 is this. What's happening? We did this. It's $1 in the bank. It's the future value of $1. Okay. Yeah. Or we did something exactly like it. Yeah. 342. How are we doing? We've got a half hour. Okay. 342. 340. Able to call bonds. The account projects that with maturity. Okay. We didn't do this? We did this. We did 342, right? Okay, 344. On September 1st, ABC signed the 9% amount of borrowed plus accrued interest due 6 months later on March 1st. Recording the payment of notes at maturity, what would happen? They want to know how much is the interest expense. Well, the interest expense is for January and February. So we're talking about 2 months, and we're talking about, $1,000, $100,000 times 9% times 2 months. It's known as 1/6. So 1/6 of 9% is 1.5%. So it's about 1,500. Debit interest expense of 1,500. Right, that's it. C? Yes?
328.
328. Which of the statements is true about operating cash flows? The indirect method is simpler for them. No, they don't. The indirect method is simpler for them. No, it's not. The direct method is simpler to understand is used. No, that's not true. Direct method is simpler for D. Finished. Next. Yeah. What?
338.
338. Gain contingencies. Usually recognized coming in when? Never recognized. So the only time when the gain is certain, and it's not really contingency. So the answer is D, because they're never recognized. If it's certain, then what do you mean it's a contingency? Well, you got a gain contingency, but it's certain that it's going to happen. That's not a definition of gain contingency. So, yeah. 355. At the beginning, we began over when you were in product. We're in the product may cause 4% of net sales. That's 5%. It's the same thing. We did something that's the exact same thing earlier in the day, so we'll just skip this one. Yeah. 359. The account warranty liability is closed at no. Liabilities are never closed. Is adjusted in the year. Yeah, B. Is credited each time? No, it's not. It's debited. Has a year-end credit balance? No. That's wrong. So B is the answer. That's it. Next. 369. The finished goods eventually turns into what? Finished goods, when we sell it, turns into cost of goods sold expense. 364, okay? Cost of goods sold. 364. ABC's owner was purchased 700, which will find what it sells it using a perpetual inventory system. Perpetual inventory system, they have to credit the inventory for 700 and credit the sales for 1200. So credit inventory 1200, that's ridiculous. They debit inventory, that's ridiculous. They debit cost sold and credit D. That's the only thing that makes any sense. Okay, yes. 367. The balance sheet of ABC at the beginning and ending of the year, netting on sales what is the return on assets? Well, what are the assets? The average assets of 1.6. And what is the net income of that? 240. 240 over 1.6, you'll do the heavy math yourself. Yes? 361. The bonds are issued at a premium, the effective amortization. And each subsequent instance, the cash paid is, well, we did something like this, but the point is, at a premium, the cash paid is more than the interest expense because we're not going to pay back the same amount we borrowed. So it's more than if the bonds, the cash paid is, no, it's not, the cash paid is the same, is greater than the interest expense B. Okay, yes? 331. 331. 331. ABC buys widgets of 5, sells income for 8. At collection, what is the effect on net income? At collection, there is no effect on net income because we pick up the income at sale, not at collection. Next. No effect. C. Yes. 314. Last year, company inventory and the end of inventory. Okay. Last year, not this year. This year the balance sheet would be wrong. No, this year everything is going to be okay. Neither this year balance sheet, no, that's wrong. Both this year's balance sheet will be wrong. No, this year's balance sheet, but the income statement will be wrong this year. D. Finished by definition. Because it's, yeah. 311. ABC sales are going to cost of goods sold equals 20. In the beginning of the inventory and the ending of it was what? Inventory turnover ratio. This is a definition. The inventory turnover ratio is what? Is cost of goods sold divided by average inventory. Average inventory is 2,000, 2,000. Cost of goods sold is 20,000, 2,000, 10 times B. Okay, next. Yes?
312.
212. 312. Company orders office supplies in June. These supplies are received in payment in July. This supplies in August. In which month should the company record supplies expense? Expense is the month that you use it. Finished. Next. The month that you use it. The month you use it is when you expense it. That's it. Yes. 313. What is expensed in a sales office? In a sales office, everything is expensed. That's it. Okay, next.
310.
310. When a company delivers the product to customers previously paid, the company goes, if they previously paid it, that means what? We have an unearned revenue type of account or something. So what we're going to do is we're going to credit, we're going to debit that liability account. So we need a debit to a liability account, debit to a credit to a revenue account. B. Next. 318. 318. Assuming the current ratio on that asset ratio of 0.8. How will an increase in accounts receivable affect the ratio? Well, an increase in accounts receivable is going to make them both go up. There's nothing to talk about. You don't have, it's irrelevant. So the answer is it's going to increase it. Yeah, by definition. Next. 319. Company has the following cash flows for the year. What am I reporting for the net investing cash flows? Okay, just go through the net investing cash flows. Inventory is operating. Sales go to the operating. Receivable overall is financing. Purchased land, 180. That's down. 180 down. Purchased treasury stock. Purchased treasury stock is financing. Paid dividends is financing. Sold the delivery truck. That's it. 30. So 180 minus 30 is 150. 150. That's it. There it is. 317. Management can estimate a loss that will occur due to litigation against the company. And the latest probable. Probable means, yeah. Then a contingent charge should be, that's reported as a liability, disclosed and reported, because it's just 244. 244. 244. 244. The True Blood criterion is used. No, managers don't use True Blood criterion. Managers use criterion to make themselves look good and to increase their bonuses. They couldn't care less about the True Blood criterion. So it's not used by managers. It's used by accountants to make rules for financial reporting. That's it. It has nothing to do with managers. Yes? 248. On December 1st, payable with the amount borrowed plus according to which of volume. We did something like this, but you're going to record an interest expense for this 1 month. So 1 month, 5% of $300,000 is 15,000. Divide that by 12 is 1,250. So there it is. Okay. Yes. 241. 249. Which statement is true? The accounting for a defined benefit plan usually requires an actuary. Yeah, that's true. Goodbye. No way you're going to figure out what's going on in a defined pension benefit plan without an actuary. That's, remember what an actuary is? That's an accountant with brains, but without the personality. Yeah. Yeah. 222. When I raise money for my business, I'll be better off if I issue debt. It depends on how well the business does. Come on, you can figure that out yourself. No? If the business doesn't do that well, if I issue debt, I will die quickly. If the business does really well when I issue debt, I will do very well. So increased risk, it depends. C. Yes? 275. ABC has a fine which 1 million is payable in each of the next 5 years. Balance sheet, there is 1,000 that's current and 4,000 is long-term. B. Next. Yeah. 1 million is current liability for 1 year. Yeah.
349.
349. You will get offers right after this class. You will get offers. You will get offers right after this class. 349. After evaluating the lower cost and never revising the accountant prepares year-end adjustment to what? I think we did this, but anyway, the entry is reduce the inventory, debit the expenses, so reduce the company's stockholders' equity. D. Next. 360, 360. 360. The year-end adjusting entry for warranties, debits, what's the entry? It's always debit warranty expense, so debit and expense. A, finished. A, yes. 356. Of the buying inventories, raw, work, finished. How many would you find in the factory? We did this already. I'm not even going to answer it. Yes, next. 348. We did something just like this, 348. So, okay, ABC corrected at the end. But we did this, or we did something exactly like it. Next. Yeah. 223. We don't want to bore anyone by doing the same type of questions again. $223. Prior to the end of the year, which would explain the allowance for length of accounts having a debit balance. Well, allowance of uncollectible accounts is set up, let's say the first year, by debiting bad debt expense, crediting allowance for that. Now, debit balance means every time we wrote things off, we debited that. So we wrote off more than we thought we wrote off. In other words, we underestimated the amount that would go bad. See what says that. The amount of actual uncollectible in the current years was less. No. The amount of actual uncollectible in the current year was greater than the estimate of accounts made at the end of the prior year. B. That's it. Next. 309. 209. Date. Beginning of, we did this. We did something exactly like this. Next. 304. Calculation of ending revenue on which statements? Well, ending inventory is on which statements? It's got ending inventory is on the balance sheet and it's on the income statement. So it's on the balance sheet and on the income statement. And statement of changes in equity, statement of changes in equity has the income statement, so it affects that. And it has nothing to do with cash flow, so the answer is ABD. Right? Yeah. What?
More than one answer, do we need to circle all of them?
If you want to get the points, yeah. If you don't want to get the points, then you don't have to. You can do whatever you want. You can write your name on the thing. Yes? What?
305.
305. Which of the following never pay taxes? A C corporation sometimes does. When do they pay taxes? When they have income, they pay taxes. So that's wrong. Partnership never pays taxes. And an S corporation never pays taxes because the taxes are paid by the people who own it. Those are flow-through entities that don't pay taxes. Yes?
303.
303. During the first years, we did something like this. Yeah, we may have done the exact same one. Next.
307.
307. Which are the most likely reasons for a company to have an increase in average collection period? An increase in average, it means it's taking them longer to collect. Now, why is it taking longer to collect? Either because they give more credit, more liberal payment policies, or because the economy is in a tailspin and therefore it's taking them longer to collect, or something like that. Okay. The company has become more lenient in its credit policies. That's it. Okay, finished. Hey, I don't have to read the rest of the garbage. Okay, yes.
Yes.
Hey. Next.
306.
306. Assuming current ratio of 1, how will the purchase of inventory with cash affect the ratio? Well, what's going to happen? Inventory and cash are both in current ratio, so what's going to be the effect on the current ratio? None whatsoever. It's not going to affect the ratio, it's the same ratio. 315, 358, whatever. 358. ABC by which provides something to account for 8. From a cash flow perspective, receivable is not cash, so anything that's not cash is not cash, so it's valued at 0. From a cash flow perspective, cash is the only thing that's measured. So anything that's not cash, like inventory receivables, are measured at 0. That's what a cash flow perspective is. All we look at is cash flows. So receivables are not cash flows. Next. 297. Which of the values is a negative sign that a company is not selling its inventory quickly? They're not selling its inventory quickly. A high inventory turnover ratio means they are selling quickly. That's ridiculous. Both a high inventory, that's ridiculous. A low average days in inventory. No, average days in inventory, they're keeping it very short, so they're selling it a lot. A low inventory turnover ratio, D, that's the answer. Okay, next. Yes?
It's a bit hard to hear you back. Can you highlight the answers? Like, those over them, please.
Excuse me?
It's
It's a
getting
bit
hard
hard
to
to
hear
hear
in
in
the
the
back.
It's hard to hear in the back. I'll yell. Okay. Yes? 370. What is the operating income? We did something exactly like this. I'm not going to do it again. Next. Yes?
355.
355. At the beginning, we began over when you were in his products. We did this. Next. We did this or something exactly like it. What? 206. 206. 260. Okay, that's closer. 260. 260. Which of the following is not, oh, I hate those questions. Which of the following is not, which one of these is false? So which one of these statements is false? Okay. The mixture of liabilities and stockholders' equity is called its capital structure. That is a true statement. That's the definition of capital structure. As a company's level of debt increases, the risk of bankruptcy increases. That is very true. Interest expense occurred when borrowing money, as well as dividends paid to stockholders, are both tax deductible. That's ridiculous. Dividends are not tax deductible, so that's at C. Finished. Okay, we got 9 minutes. I will stop punctually at 2:30. Yeah, unless we run out of questions, in which case I'll stop then. Yes? 262? 262. 262. Okay. 272. 272. 267 or 272? 272? 267. ABC sells one company. Well, DF sells one. We did this with different names. Okay. We did this with Simpleton or whatever. An hour and a half ago. Next. 268. Which of the following best explains the meaning of total stockholders' equity? Total stockholders' equity means the total amount of capital invested plus profit retained. Yeah, that's common stock and retained earnings. A. Finished. B. The difference between total revenue and total less dividend for the year. No. Or for the life of the company. No, because that doesn't include common stock. The amount of the dividend. No, that's ridiculous. Okay. The answer is A. Yes. What?
258.
258. 258. Social Security. Social Security is defined benefit plan. Well, yes and no. Is a defined contribution plan? No, it's not. Is an optional pension plan? No, it's offered with no. So the answer is A. It's a defined benefit plan. Right? It's the only one that makes any sense. What? Any questions on this one on 258? Yeah. 270. 270. 273. 273. ABC sold inventory with those purchased with $700. Everything which of the following when it sells the unit. We did this. Next. Or we did something just like it. Yes. 95. 95. ABC shares at the beginning of the year. Or we did this. In fact, we did this exact question or something exactly like it. Next. Yes. 90. 90. 90. 90. Par value of shares is a very important number. No, it's an absolute garbage number. Okay, so a garbage number for common stock, an important number for preferred shares, yes, because in preferred shares it's used to calculate the dividends. And so that's it. Okay, so C. Next. The answer is C. Yeah, what? 92. State and Senate generally prefer giving their workers a defined, well, what? A state and city politician, their time limit is, you know, if you give them an eye test and you see how far they see, they can only see till the next election. They can't see anything beyond the next election, because if they win the next election, it's good. And if they lose the next election, they're dead. So all they care is about what happens from now to the next election. So therefore, they're very willing to promise you that, you know, 40 years, oh, we're going to give you a pension plan, but we're not going to pay anything now. But, you know, we're going to let the politician 40 years from now worry where they're going to get it. So that's what they like to do. They like to promise in the future and not pay now. And what is that? B. That's why, if you notice, almost all local and state politicians, and people calculate it as the unfunded amount, in other words, the amount they didn't contribute that they owe, and it's in the trillions of dollars. It's somewhere among about the size of the U.S. GNP. And these things are, you know, this is, something's going to happen at the end with this, because there are serious problems with this. Yes? What? Can't hear you. 94. The allowance method. When we do the year-end adjusting amendment, that's, so what is the entry? The entry in the allowance method is what? It is credit. Allowance of bad debt, debit bad debt expense. So credit allowance for bad debt decreases assets and decreases income. D, yes. What? 93. Periodic versus perpetual accounting system. Now, in theory, periodic and perpetual will get you the exact same answer. Unless you're a LIFO, that's another interest. So periodic results in a higher no, and in a lower no. Sometimes they should give you the same cost of goods sold pretty much, except for the LIFO exception, which no one uses. Yes. So the answer is D. Yes. 90. 96. 96? When we collect sales tax, we debit cash, and then we credit a payable to the government. Payable to the government, a liability. Okay, 4 minutes. 67. 57. 57. A capital financing lease. That's discussed on Blackboard. Next. What?
65.
65. By the way, I want to congratulate you. I got an email from Professor Joyce on the SAM projects, and they caught some people cheating on the SAM projects. And he said, our class had the lowest cheating by far of any other class. In other words, and they caught one person cheating. So I said, oh, sure, give me the name, I'll give him an F in the course. He said, no, you know, we just took off the 2 points for the thing. We don't want you to fail necessarily. I said, no, I make it clear to my students, one ethical lapse, you're out of here. That's why no one cheats. Turns out that one student they caught that is, you know, in our class is not one of my students. So congratulations for the honesty. Yes. I thought I was being nice because I was giving an F in the course. I wasn't trying to get him thrown out of the school for cheating. So I thought I was being really generous about it. But yes, which question are we up to? Congratulations for not cheating. Yes. Where are we up to? What question? 65. Journal entries to record dividends are made when? When do we record it? When the dividend is declared. So we make an entry on declaration date, and when we pay it, we got to pay it. So C, declaration and payment date. Next, yes.
146.
146. 2 minute. 2 minute. Sudden death. An operating lease will have how many of these expenses? In an operating lease, that's not a financing lease. That's, I walk into an apartment, I rent it. What kind of expense do I have? Rental expense. There's nothing else to talk about. So the answer is rental expenses.
So what?
1. Yes.
4.
274. Let's go 198 first. 198 is because 198. But if over the year the selling price of inventory increases, but the cost of the inventory remains constant, selling price, but the cost remains constant, but the same. We keep increasing the selling prices, but the cost remains the same. Well, if the cost remains the same, what does that mean? What is the difference between LIFO and FIFO if the cost remains the same? There's no difference. So the answer is there's no difference. So the answer is C, they're going to be identical because they're the same. Yes, someone who was next? I forgot who.
274.
What?
274.
2 what? 5. Maybe 275? Which accounting number has the single greatest impact on stock prices? What's the answer? Net income. Finished. End the story. What? 246. 46. 46. 1 minute left. When treasury stocks resold gain dividend cost and cash received when it's sold has no effect, increases stockholders' equity because it goes into APIC. It increases stockholders' equity because it goes into APIC. The answer is D. Yes. 47. In accounting, goodwill is amortized over its useful life. Maybe recorded whenever a company achieves a no. Must be expensive periods of course. No. Maybe recorded when a company purchases. May be recorded when a company purchases another business. It's not amortized over its useful life because there's this complicated rule how you take it over. and you calculate it, so the answer is D. Last question, 48. Okay. When a firm gets riskier, what will happen to its bonds? Well, when it gets riskier, that means the chance of my getting collection on that bond is getting lower. Therefore, I'm not going to pay that much for the bonds. So what happens is I'm not going to pay that much for the bonds, so the price of the bonds should fall. So the market interest rates of the bonds will go up if it gets riskier, yes. And the price of bond, no. The prices won't go up. The price will go down. Who wants to buy garbage like that? So the market interest rate of the bonds go up and the price of bonds go down. C. Thank you very much.